But let's go back to secondary markets. Let's analyze some more numbers. Mahindra Finance on our radar. Let's welcome on board Ramesh Iyer, the MD and VC. Ramesh, loan growth and disbursements have been very strong for the quarter gone by. Tell us a little bit about where the demand is coming from, what is leading to this kind of strong growth.
So if you kind of look at, for us, it's coming from across the country. The vehicle demand is pretty high. Tractor demand is continuing to be robust. Pre-owned vehicle demand is high. We had relaunched our SME program about 6 months back. That's showing traction. So I think without exception, either by product or by geography, we are clearly able to see growth coming from all the fronts.
Right. Tell us a little bit about the second half of the fiscal as well. Always a strong period seasonally. Do you think this kind of growth is going to continue and the 10,000 crore plus disbursement run rate is here to stay? And if so, for how long?
So clearly, if we look at the trends in the second half, we just put out our October number, I guess. We have had the highest disbursement ever in the history of MMFSL. We have had about 5,000 crore plus disbursement in the single month of October at the back of phenomenally a great festival mood, both Dussehra, Diwali at the same time, in the same month. So I think very clearly we are able to see the momentum of growth that we saw in each quarter. And as you rightly said, the second half is even much better half compared to the first one. And this year, again, the monsoon has been very favorable. The support prices look good. The infra is opening up. So I think we are definitely confident that the second half would continue to see a growth trend that we have seen so far. In as far as how long do we see this happen, I think it's important to understand the cycles hold up for at least 2 or 3 years. That's what we have seen, even though there have been some jerks in between due to disruptions. But clearly, we think this will hold on. The rural demand is pretty good. I think the people are very excited, and we have yet to see freight rate going up or passenger fare go up. If all that also happens, the cash flows will further improve for the rural market. So I don't think we have any doubts on the growth momentum being maintained.
Just taking a look at your net interest margins, they've come in sharply lower. So what would be the reason for that?
So it's a very conscious call, right? I mean, we put out even last time that we will look at certain high-end customer even within the rural geography, and they obviously come at a little lower yields, but they are eventually supposed to give us good quality. So therefore, it was a conscious decision to build some book coming from the high-end segments from this market. Second is there is a product mix change which has happened, when your car portfolio starts to grow a little better or your UV portfolio grows a little better, they come at a lower yield as compared to tractors or pre-owned vehicle. The non-availability of a pre-owned vehicle is actually denting some growth in the pre-owned market for us. As that catch up, one is you will start seeing the correction of the yield beginning to happen. Second is the cost of funds definitely have gone up, and we've not passed on all the borrowing costs to the consumer. And we have said that in the past, it will happen with a lag. We have started moving our lending rates, but it won't happen all of a sudden. But as we catch up in the next 2 quarters, that would also improve. The third is we are holding little extra money to be able to meet any exigency requirements given the liquidity position. And therefore, we are there is a carrying cost for an extra money that we are holding, and that does build a little pressure. But I think the yields, as they start improving by a change of our lending rate, we will start seeing the improvement to the NIMs happen as well. But to some extent, it's a conscious decision to bring in high-end segment customers to be able to mitigate the overall asset quality improvement that we're looking at.
Right. Mr. Iyer, Opex as well has come in elevated. Can you talk us through what's happening here and what we can expect on this front?
Clearly, even on this, we have put out very clear directions even in the past. One is last 2 years has been very subdued from an employee salary increase perspective. So we have taken some correction, and that will even out over a period of time as the productivity starts to improve. I think the second factor is we have substantially invested in the technology, digital, and the data space. And they are an investment in nature, though they are expensed out. But clearly, we will start seeing benefit of that as well when we are looking at the different segment of customers, They are more partnership oriented and they don't need physical action. And you will start seeing as the book starts to build up from those segments, you'll start seeing the cost getting corrected as well. At this stage, we are not overly worried about the increased cost. As the book starts to grow, we are just about seeing the AUM starting to grow. And as we reach a 15, 20, 25% kind of a growth to AUM without incurring any further cost, you will start seeing the cost also getting corrected.
They're also joining in. While you go through the fine print, provisions are clearly lower than what had been penciled in as expectations. Talk to us more about that. And are you comfortably provided for under the new RBI rules?
So if you look at, the collection efficiencies have been extremely good all through the year, upward of 90, 95, 97% kind of a number. And that's a reflection of the asset quality improvement. And again, that comes at the back of the rural market doing extremely well. We had said when the IRAC norms were announced that we don't need to be in a hurry to do this. And when we come to the real date, you will start seeing there is no further provisioning required, because that's the time we start seeing improvement to the overall book as well. And we are exactly poised for that. If we were to take an October position, through IRAC requirement, there is a 900 crore or 1000 crore requirement of additional gross NPA coming in, but that does not need any additional provision to be made for us, because we have 58% cover on our current NPA and we are net at 2.89, and whereas we are required to maintain only a net of 6% under IRAC. So we are extremely, extremely comfortably placed on the NPA front, both at the NDS level as well as at the IRAC level.
Now, it's been almost, a month since the RBI directed the outsourcing ban on you. So enough time has gone by to now speak with you, sir, about the impact of it. What has been the impact of it, and what are you doing to also get that ban lifted?
So, it's important to understand repossession is never the first resort for collection. It's the last resort for settlement. And if cash flows are holding up so well, obviously the need for repossession also starts to decline. But that doesn't mean that there is no repossession requirement. There are defaulting customers whose vehicles and tractors have to be repossessed. Typically, we repossess about 4,000 odd vehicle per month. We are allowed to repossess on our own, but we'll be very cautious on how we want to do that. It's not a very easy task for an employee to be carrying out that. So to that extent, maybe there will be a pressure of about 2,000 odd customers whose vehicle we would love to repossess through agencies is something that we are not able to do. Fortunately, with overall collection improvement, that 2,000 number that we are not able to act on immediately is not going to be the spoiler at this stage. But we are also confident at the same time that every action that we have taken to ensure that we get the order restored for us to be able to repossess in future, all those steps are being taken by us. And we are confident that we would get the permission to go ahead and repossess in future. But currently, as we are in this position today, about 2,000 odd or maybe 3,000 odd numbers is where we would love to repossess immediately, but that would get a little delayed. But to be honest, that doesn't really spoil our overall asset quality game that we are into.
All right. Thank you so much, Mr. Iyer, for joining in and giving us a flavor of what the quarter has been like, as well as your outlook on loan growth and margins.